The Federal Reserve gets set to make its latest interest rate decision on the last day of July. According to the CME Fed Watch tool, the chances of a 25 basis point cut to the Fed funds rate is almost a certainty at more than 90%. Joining me to discuss is Oliver Blackbourn, fund manager at Janus Henderson, who's live in London. Thanks so much for joining us. So we have that strong payrolls report beating expectations, at least on the headline figure. The wage data a little bit softer though. So given the strength that we're seeing in the labour market, do you think that the Fed should and will be cutting rates this month?
We certainly expect there to be a cut this month. The market's pretty certain of a cut. We think that there are some good reasons why they can justify this. You have to remember that the Federal Reserve is acting at very low interest rates relative to history. And if you look at recent commentary, you've seen that Jay Powell has indicated this. He talked about an ounce of prevention being worth a pound of cure. That sounds like someone to me who's looking to act preemptively to support the economy.
So give us a sense of your outlook towards the US economy then. How concerned are you about the prospect of a slowdown?
Well, we think we're at the end of a third mini cycle since 2009. The first slowdown was driven by the Eurozone debt crisis back in 2011. Second was driven by the oil price slump in 2015. This one has been driven by the headwinds from global trade. We think that we're going to see the US economy slow from the high 2%, low 3% annualized rate that we've seen in recent quarters. We're going to see the unwinding of the high-level stocking that came in towards the end of last year. A lot of companies increased inventories due to the trade tensions. As they ratcheted up, they wanted to make sure they had stock going forwards, and that tends to be followed by a period of unwinds, and that tends to be a drag on growth. However, at the same time, the US consumer is the backbone of the US economy. If you're going to see a recession, you need to see the US consumer start to run into problems. As we saw with the labour market report last week, the labour market remains very strong, and that means that despite some of the sort of slowdown in things like wages, as you said, that the total aggregate income growth, the sort of pots of money that the US consumer has to spend, does remain continues to grow at a reasonable rate. You can look elsewhere as well and see that mortgage rates have come down, and that should support the housing sector. And if you look at the sort of smaller businesses confidence that was out recently, that continues to be at a very high level. Even if we've seen a small dip, relative to history, they're still very confident of the future prospects.
All right, so let's get your temperature on the markets then, because Morgan Stanley recently downgrading its outlook for global equities to underweight, and that's despite forecasting a rate cut at the same time. So do you think that this dovish move that we're expecting from the Fed will be enough to support the markets?
So it's been a very strong start to the year. I think we have to recognise that. The S&P 500 is up about 20% already. The market no longer looks cheap. It's up on about 17 times PE. And a lot of this bounce from the poor final quarter of last year has been driven by an expectation of monetary stimulus, and that does leave room for disappointment. However, on the other side, you've got to remember that there's been $55 billion worth of flows out of US equity funds so far this year, and at the same time, investor sentiment is still bouncing from very low levels earlier in the year. That means that investors can still reallocate to US equities, and that could easily push the market on throughout the rest of this year.
What about the US dollar then? Because I'm wondering whether you think now's a good time to start selling the greenback. Obviously, we've been in a sustained period of gains for the dollar across this year and last year. So with this sort of dovish tilt, is this the start of a reversal?
So we agree with you. We're probably towards the back end of a multi-year bull market. We've seen the dollar trade in a range for the last 12 months, and we think that probably continues from here. You're seeing the erosion of that support from interest rates as the Fed turns more dovish. The Federal Reserve has space to cut interest rates, whereas if you look at other major central banks around the world, they're operating around about zero or below in many cases. It's harder for them to cut interest rates, and that interest rate differential has been one of the major supports for the US dollar. Therefore, to see sustained dollar weakness from here, you have to believe that economic momentum in the rest of the world, and that means basically Europe and Japan, is going to improve markedly relative to the US. Both of those areas are sort of mired in trouble. Their economies are very weak at the moment. If you just have to look at some of the German data that's been out recently, manufacturing orders, for example, that tell you that those economies are still struggling. By comparison, the US is in reasonable shape and has better economic momentum. We'd have to see a structural shift to move away from this sort of low volatility regime in the US dollar, we think.
Okay, so what about the bond market then? Because we've really seen the bulls come back into force. Do you see short-term US yields continuing to push lower?
So we think we might be in for a period of backing up. We think once you start to, the market priced a very high level of recession risk. If you go back a week, the market was pricing a reasonable percentage chance of 2 cuts actually at the end of this month. That's all been priced out since the labour market report on Friday, and that's supporting higher yields. If we think about this as just being yet another mini cycle that doesn't lead to recession, then the bond market should start to move higher at some point. Otherwise, you have to believe that we really are at the end of this cycle, and that's quite a strong call. Whilst the US consumer is in good shape.
That was Oliver Blackbourn, fund manager at Janus Henderson, joining us down the line from London. I'm Victoria Scholar, and thanks so much for watching IGTV.